Welcome to this week's edition of Retire Simply DFW, brought to you by 𝐿𝐼 Retirement. I'm your host, Kristen Oakley, and I'm joined today by Scott and Angela Winstead. They are co-founders of 𝐿𝐼 Retirement. One of my favorite couples. It's so good to see you.
Thank you.
Great to see you
yes,
too.
fantastic to see you.
Well, we always have such a great time, and I love that you always put together such valuable content for our viewers at home. And today we are going to be talking about a very important subject as it relates to your retirement. One of the pillars of your Simply Retirement Plan, the L, stands for less to the IRS. If you want to know how you can pay less taxes and make sure that you're not inheriting a big tax bomb in your retirement, you are not going to want to miss today's episode. So let's start with a very important acronym. The acronym RMD. Now, I have been in lots of conversations with folks, and recently, a couple months ago, I actually met with a couple, and the wife is 65, the husband is 70, and we were talking about some things related to retirement, and I mentioned this important acronym RMD, and they both looked at me and said, "What is that?" And this is very common, isn't it, that a lot of folks don't understand the subject matter. Now, it doesn't stand for really mean and dastardly, as you might think. What was the other acronym that you said?
Sometimes we say rotten, miserable, and disgusting.
Yes, right? So let's start with what RMD actually stands for and why folks need to understand this important concept.
Yeah, so, tax planning for us is really, really important. So again, L in Simply stands for less to the IRS. And what we find is it's one of the few things you can actually control in your retirement. We don't really control if the market goes up or the stock market goes down, but we can control our income typically. And when you control your income, a byproduct of that is being able to control your taxation. And so we just believe, hey, the IRS is going to get some form of taxes, typically from the way someone has saved. So we either can get out in front of it and have a plan in place, or we can kind of be that ostrich that puts its head in the sand and just let it happen to us. We're big believers of doing the first one.
Yes,
right?
Don't be ostriches.
So
no ostriches.
What happens is RMD is simply just a acronym that stands for Required Minimum Distribution, okay? And it sounds kind of fancy, but here's really all it means. It means when you hit a certain age, the IRS mandates, or they require, that you take a minimum amount out of your pre-tax retirement accounts or a distribution. And when that money comes out to you, you have to report it as extra income, and you get to pay income taxes. Typically what we would say would be your ordinary income tax rate. So that would kind of be, whatever bracket you're in, right? The 20%, 25, that sort of thing.
Now, you mentioned a very important word. This is these pre-tax accounts. And a lot of folks, that's where the majority of their money has been saved for all these years. We're talking 401ks, IRAs, 403bs, 457s, right? So talk a little bit about that distinction of why this is so critical for so many people in retirement.
Yeah, those are going to be all of those accounts. Remember when you're thinking about taxes and you're thinking, oh, I love to save taxes this year, right? We're not thinking about retirement, so we're not thinking long term, we're thinking this year. Well, if I contribute to my retirement account, what do I get to do? I get to write that off of my taxes, right?
It lowers your taxable income for that year.
Exactly, exactly. And so any type of account where you've put in money in that manner, like you were saying, 401ks, IRAs, all of those pre-tax account SEPs, if you're an independent person. But we don't think about the consequences down the road. So whenever we save in those accounts, those are the accounts that we're talking about right now and why it's so important to address them right now.
Right. Pre-tax, tax deferred, that just means you're going to have to pay tax on it sometime. You're just kicking that can later down the road.
That's right. Listen, forget about those words, okay? It just means money that you haven't paid tax on yet. Tax deferred and pre-tax, that's for all of us to talk about. It's for anything where you got a tax deduction when it went in, okay? Yeah, absolutely.
Well, it's so important to know that because you have to plan for it, as you were talking about. So how does the IRS calculate a person's individual RMD amount?
Oh, Kristen, we get that question all of the time. Because when you learn about this big idea of things that you have to do later on down the road that you didn't know about, then we want to know, how do we mitigate it? Like, what are the rules around that?
Right.
So what they do is they take all of those accounts that you haven't paid taxes at. And this is what I mean. If you've had lots of different jobs, you've contributed to lots of different 401ks, it's all of those, and the IRAs. So they just round up all of that money. They come up with a really big total. And let's imagine it's $1 million. And they say, you know what? When you hit that RMD age, you're going to have to take out a certain percentage of the grand total and report it as income. And you know, the age range is changing a little bit.
Yes.
The percentages change all the time, but the percentages are based on your life expectancy. Really, how long do they think you're going to live?
Right.
And they start out a little bit less, and I'm using 4%. It's just a very general round number. And then each and every year, that percentage increases. So for example, if I saved $1 million in my pre-tax accounts, my 401ks, and I have to take out 4%, I'm talking about $40,000 that I have to take out that year, whether I want to or not.
And that's something that has to be planned for, because it has major implications on the rest of your financial plan.
Absolutely.
Yeah, it's so important because when that added income comes in, it can cause a lot of problems. And you know, some of those being you maybe jump a tax bracket, right? So hey, I was in a lower tax bracket, but my percentage, as Angela mentioned, got higher and higher and higher, forced me into a higher bracket. A lot of other things are impacted in your retirement by having too much income, which I know sometimes can sound like, well, how could that be a bad thing? But you know, hey, the more income you have in retirement, they can tax your Social Security more. The more income you have in retirement, you may pay 2 or 3 times more for your Medicare premiums than your neighbors because of that. So there can be a lot of unintended consequences if you haven't developed a plan for how these distributions are going to come out to you.
For sure. And then I know we're going to have to cut to commercial quickly here, but talk to me a little bit about what happens if someone, heaven forbid, tries to do the calculation on their own and they get it wrong. Tell us about that penalty.
So there's a penalty right now of 25%, basically, if you forget to take this mandatory distribution. So you definitely do not want to forget to take your mandatory distributions.
Or get the calculation wrong, because then you're still going to have to pay the tax on it and that 25% penalty.
Absolutely.
Yeah. Gosh.
One thing I like to share with everyone is, we'll help you with that. You know, our clients, that can be kind of scary. That's just a normal part of our RetireSimply process. We let our clients know exactly what those distributions are and that they need to take them. And we will lovingly give them a couple of reminders. But if you're someone that wants help like that, and you're 3 to 5 years away from retiring, and you've saved $300,000 or more, that's the perfect kind of planning for you that we do. So I invite you right now to pick up the phone, give us a call. Our number's 844-861-5203. And we are here ready to help you move through all of those different challenges to navigate your retirement.
Angela, Scott, thank you so much. To our viewers at home, we are going to take a quick commercial break, but we encourage you, pick up the phone today so that you can get your own complimentary RetireSimply plan that will help you navigate all things retirement, including these RMD calculations that are so critical to ensure that you stay on track to reach your retirement goals. Call the number on the bottom of your screen, 844-861-5203. You're also welcome to take out your smartphone. You can open up that camera app, just scan that QR code in the bottom right-hand corner of your screen. That will take you over to a landing page, and you can answer a few simple questions, and a member of the Compass Retirement team will reach out to you to plan a time for you to come in and get your complimentary RetireSimply plan. When we come back, we're going to be talking more about how you can mitigate this tax bomb in your retirement. Stay with us.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to Retire Simply DFW. I'm your host, Kristen Oakley, here with Scott and Angela Winstead, the co-founders of 𝐿𝐻 Retirement. We are talking today about RMDs, required minimum distributions, and how you can prevent them from being a ticking tax bomb, if you will, in your retirement. And so let's talk about that and unpack that a little bit more. I know we talked before the break, some highlights, but why can RMDs be so problematic for so many folks?
You know, Kristen, I think when you're talking about tax planning and retirement, you have to ask a few fundamental questions right up front. So, for instance, what do we think taxes are going to do? Go up or go down, right? Most people, when we take that survey at a live event, say, well, of course they're going to go up. And we agree, right? You know, we have a national debt in this country of, let's say, over $30 trillion.
Yep, and
right?
It's gone up since the show started.
Exactly,
right?
It's going up a lot, right? You know, we've got high inflation, right? We've printed a bunch of money.
Yep.
There's not a lot of room for taxes to go down. So if we just fundamentally start with, hey, we believe taxes are going to go up, should we be paying taxes now versus paying later? I think one of the main things we want to be asking ourselves is, well, where do I expect my income to be in retirement? Right. And what do I think taxes are going to do?
Yes.
And so when we think about our income, most people tell us, well, my income will go down in retirement. And you know what? We find for a lot of people that's true, right? But just because your income goes down doesn't mean you're paying less percentage of tax. Because
that's so critical.
our tax code has what we call tax brackets, and they're really big, right? So for instance, let's just make it simple. Let's just say that the 22% tax bracket if you're married, right, goes from, you know, $90,000 to $190,000, okay?
Right.
And let's say while you work, you earned $130,000 of income, and then you retired and now you're earning $100,000 of income. Well, did your income go down in retirement? Yes, but are you in the same tax bracket? Yes. And I think a lot of times we forget that because our tax rates are percentages and not dollars, the default is, well, I'll just pay less in taxes. And that's not necessarily true.
Right. Percentage math. It'll get you every time.
Every time. Every time, for sure.
And I do love one of the questions that you throw out all the time is, would you rather pay taxes at rates you know or at rates you don't know, right? So let's take advantage of the rates that we know, because most of us don't know what the tax rate's going to be when we're 80 or 75.
I mean, you know, it is. The federal government has, and the IRS has the ability to set these rates at whatever they want. So
and change them at any point.
That's right. And two ways to really get out of debt. We talked about that 30 trillion, right, or 31 trillion. Well, one thing you can do is print more money. And when you print more money, that causes inflation, right?
Yes.
But the second way to get out of debt is you can raise taxes.
Right.
So if we start looking at the debt compounded with the inflation and all the things that are happening, it would beg to stand that, you know what, taxes are probably going to go higher, so I should be doing some planning to pay now versus pay later. But it's not a just wing it sort of thing.
Right.
Right?
Yep.
If you're not careful, you can really mess this up by not having the proper plan for it.
Well, because we always talk about on the show that how you make a decision in one area of your financial life does and will affect all the others. And so you had mentioned in the first segment how an RMD, once someone receives that income, that can now have consequences on their Social Security and Medicare. So talk to me a little bit about that.
Yeah, so, you know, as we start taking those required minimum distributions, remember we talked about how do they figure out how much we owe them, and it's on that percentage. And as we continue to age, that percentage goes up and up and up, which means our income is going to go up and up and up.
Right.
And when all of those puzzle pieces of your retirement start connecting, here, your taxable income, it affects your Social Security taxation. So let's pretend that I'm used to getting $2,000 a month and my income keeps going up. They end up possibly taxing my Social Security more. That's what happens. As your income goes up, they tax more of your Social Security. And now maybe my payment's $1,800 a month. Yes, when I'm on, if you will, a fixed income, or what I mean by that is I'm not generating more income from a job, right?
Yeah.
You really feel those sorts of things.
You do.
And, you know, same thing with your Medicare premiums. The more taxable income you show on your return, the more they can increase your Medicare premiums. You know, so for a lot of times we're talking to people because this is kind of a new concept. Who's really thinking about this? We don't typically think through those things, but wow, we find with a lot of people, they will have less Social Security and pay more Medicare premiums in their 80s than they do in their 60s. Now that's not true for everyone, but that's true for a lot of people. And if that's true for you and you find out about that in your 80s, guess what? You're usually not real happy about it. And lots of times people are not motivated to do anything about it. They're in their 80s. They don't want to have to worry about those things,
They just feel like that's
but they
the way
have to
it
face
is.
them.
Yes. What you're talking about, it almost is like, I say this with taxes a lot of times, it's like we're playing a game that a lot of folks just don't know the rule book to, right? And it's not fun playing a game when you don't know the rules.
No.
And the rules can constantly change. And this calculation is something that has to be recalculated every single year because, as you mentioned, it depends on your life expectancy. Well, guess what? Every year, that number is changing alone.
Yes.
100%.
And not even to, you know, just to remind everybody, they have the ability to shift that age. So when we're supposed to start taking our required
and that recently happened not that long ago, right?
And sometimes it's kind of, not everybody knows about it right away. So you have to keep up on those things.
So what is the critical age that folks now need to be paying attention to these RMDs more than ever?
73. 73 is what it is right now,
and
right?
it actually depends on the year of your birth. So, you know, if you're watching this and, you know, you're born early enough, your age, mandatory distribution age could still be age 70 and a half. It could be age 72. It could be age 73. They're actually saying it could go to age 75. So right now, it's confusing enough, but there could be 4 different mandatory distribution ages. So it's no wonder people mistaking them because you're not quite sure when exactly it is for you.
Yeah, and if you think this is confusing, trust me, you're not the only one. There can be lots of confusing things about retirement, but with Social Security, Medicare premiums, and required minimum distributions, we've got your back on that. So if you've got some questions, please accept some help. Let some people who know what they're talking about guide you along that path. So if you are 3 to 5 years away from retiring, or maybe you're already retired and that's fantastic, and you've saved more than $300,000 for your retirement, pick up the phone. We would love to be able to help you, guide you through some of this confusing stuff. Just pick up that phone and dial 844-861-5203, and we are ready to help you.
Angela, Scott, thank you so much. To our viewers at home, the number to call is on the bottom of your screen, 844-861-5203. We encourage you, even if some of the stuff we're talking about today might be new to you, it's not new to Scott and Angela and the team of Compass Retirement, and they would love to help you navigate through all these complexities and make it simple to help make your retirement as simple as possible. So call the number on the bottom of your screen. You're also welcome to scan that QR code. We're going to take a quick commercial break. When we come back, we are going to be talking more about these strategies that can be employed to help you mitigate this tax bomb in retirement. More after this.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter, the one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Retire Simply DFW. I'm Kristen Oakley here with Scott and Angela Winstead, the co-founders of 𝐿 Retirement, and we are having a lively discussion today about RMDs, required minimum distributions, and how you can make sure that you mitigate this impending tax bomb in your retirement. And so, gosh, we've unpacked a lot today. There's a lot to know, a lot to figure out. But one of the things I've heard you say a lot, Scott, is that you are a fan of helping folks pay tax now versus paying tax later. So can you unpack that a little bit and talk about the strategies that you employ for your clients to do so?
Absolutely, Kristen. I think it comes down to, as we talk about this, depending on the manner in which someone has saved for their retirement, there's more than likely going to be some sort of tax impact when that money comes out of the account. Again, that's the 401k, the traditional IRA, the 403b if you're a teacher, right?
Yep.
And so knowing there can be a potential tax impact, then we start talking about, well, do I want to be in control of that, or do I just want to be, susceptible to whatever the federal government, the IRS, decide to tell me?
Right.
And so when we look at this, we say, okay, well, if I think taxes are going to go up, which I think most people would agree, and I'd rather pay at taxes and rates I know today versus ones that I don't know what they're going to be in the future, but we're all assuming they're higher.
Right.
My question would be, why in the world would anyone want to wait to take money out of their taxable retirement accounts? Why wouldn't we take money out of them today?
Right, when there's a sale.
That's right.
Sale,
Pay
right?
tax on the money today while rates are lower.
Right.
Take what's left over and get it to a tax-free account. Now, when I say tax-free, here's kind of what I mean. It's the type of an account when we put the money in and we invest that money and it grows, we don't have to pay any tax on any of the growth.
It's a beautiful thing.
That's right. And when we take the money out to spend in retirement, we don't have to pay any tax. And if anything's left in that account when we pass away, whoever inherits that account doesn't have to owe any taxes. Doesn't that sound nice?
It sounds
right?
like a dream.
And what's really crazy is there's only two types of accounts in our tax code that even allow us to do that. One, I bet most everybody watching has heard of, right? And that's called a Roth account, like a Roth IRA, Roth 401k, right? But did you know the other place that you could put $1 and invest that money and have it grow tax-free, take it out tax-free, and pass it on to your loved ones tax-free? The second place we can do that is called permanent life insurance. The kind of insurance that can actually be there to help us also with care down the road, right? So the name of the game in terms of tax planning is paying now versus paying later, and then getting the money someplace to where we're all done with the IRS.
Right. Yeah, so it doesn't become an IOU.
There you go.
Oh,
Exactly.
Yes, very well said.
I'm stealing that.
Yeah,
Right?
go for it.
Okay.
I love
All right.
that.
I like that.
Yes. Well, now I know some folks watching might say, yes, I have to take these RMDs, but they might be in the fortunate enough position where they don't need that money to live off of. So talk to me about some strategies that they can employ when dealing with RMDs.
Oh my gosh, I'm so glad you asked this. When I started my career in financial services back in 2008, I had a full head of black hair. And then I started seeing these lack of tax strategies and it all fell out, okay?
Oh yeah.
So here's typically what we have found. The zebra typically doesn't change its stripes. If someone was a very good saver while they were working, they don't just automatically retire and just frivolously
And
start
blow it
blowing
all.
money.
Right.
So a lot of times what we find, especially for folks in the DFW area, is, if it were up to them, they would just leave this money in those taxable accounts because Social Security and a pension and all their homes paid off. They don't need all this extra money.
Right.
But then it gets forced to them. By the way, one thing I didn't mention is a tax-free account also does not have an RMD, which means if you don't need the money, you can just leave it there.
Right.
Right?
Yeah.
So then this mandatory distribution comes into them, and they start looking around saying, well, I don't need it, and I'm not going to frivolously just go blow it on something. So what we find is we ask, well, what's the plan for this money? And here's typically the response we get. I'm going to reinvest it. Now let's think about that from a strategic tax planning standpoint. You had an account that told you you've got to take money out and you have to report that money and pay income tax on it. You took what was left and you put it into another account and invested it, so when it grows, you have to report and pay more what? tax. And that's the hamster wheel the IRS hopes we all get on. And we start paying tax on the same dollar 2 and 3 times. And it's just not a great way to go through retirement.
It's not necessary. It's preventable.
Absolutely preventable.
Well, what about QCDs, qualified charitable distributions? Is that another strategy that you find folks employ?
Absolutely. I think, QCDs are great if you're of a philanthropic nature. I think one of the things that we also find, and I don't want to get too deep into the weeds, but happy to discuss it, is, something even like a donor advised fund. All that really means, by the way, is like a charitable gifting account. You just put some money in and you give it to charities. What we have found, though, is most people take the standard deduction on their tax return because it's hard in retirement to have itemized deductions, right?
Yep.
So this donor advised fund or something like they can generate a deduction for us to be able to get an advantage, right, and lower our income taxes. We're still going to give to the charities, right? But at least we're getting the benefit of our giving versus, well, I gave $3,000 a year to my church, but I just took the standard deduction anyway, so I really didn't get any benefit for it other than it felt good to my heart, right? So definitely it's a combination of these tax strategies that when you combine them is very, very powerful. And I'll just say this, because there is a reason the wealthiest companies and people in this country usually pay very low to no taxes. And I would subscribe to the fact that it's not because they are doing something wrong. It's because they know the language.
They know the rules.
And they know the rules.
Game, right?
And the best part is we do
know the rules too.
For folks that are in or near retirement.
Which I love. And I love that you're so passionate about helping people understand that and then being able to help them strategically plan based on their unique individual situation.
Yep, absolutely. We're really passionate about that because you have to think about as you're aging, if you pass away, then, and if people get these accounts, do they still have to keep up with the required minimum distribution?
Because you don't want to pass on a
just
tax
go
bomb
away
to them.
Yeah, it doesn't go away. They will inherit your tax bomb, or they're going to have to take care of it. And one of the things that I really like to point out is, hey, ladies, if you are listening and your husband happens to predecease you, and you've been taking RMDs, these required minimum distributions, you have been probably in a married filing jointly tax return. Well, guess what? When there's only one of you, you get moved to the single tax bracket. And so oftentimes, for us to take that distribution, our tax rate is higher. So if anything we have said has, stirred something inside of you and you want some help with this, we are here to help you guide through the big old mess of required minimum distributions. If you're about 3 to 5 years out from retiring, maybe you're already retired, you've saved $300,000, we are here to help you. Pick up the phone, give us a call right now. It's so simple. All you have to do is share with us the accounts that you haven't paid taxes on yet, your latest tax return, and we can help you.
Angela, Scott, thank you so much. To our viewers at home, thanks so much for watching. As we like to say around here, bye-bye.
Bye-bye.